All right, let's get right into it. Today in this explainer, we are going on a fascinating journey into the real-world economics of Main Street business. We hear so much about massive tech buyouts or corporate mergers, right? But there is this entire world of incredible local commerce happening literally right under our noses. So we're taking a structured, detailed look at the actual financials and operational realities of buying a local restaurant. This isn't just theory. We are looking at a real, live listing for a pizza shop, and we're going to dissect the pitch to figure out the actual reality. Just look at that number. $995,000. That's the projected 2025 gross sales figure for a single casual dining pizza shop down in Largo, Florida. I mean, that is an enormous amount of dough, pun absolutely intended, flowing through a local business. When you see a number like nearly $1 million in top-line revenue, it instantly grabs your attention, doesn't it? It sounds like an absolute gold mine. Okay, let's dive into this, because this is exactly where the theory of business collides with the harsh reality of restaurant margins. Seeing a top-line number of nearly $1 million immediately begs a critical question. If a shop brings in that much cash, what actually ends up in the owner's pocket at the end of the day? To figure that out, we need to peel back the layers of this specific business. We'll look at the sizzle they're selling, and then we crunch the hard numbers. Let's start with Section 1. The $1 million pizza shop, or as I like to call it, the sizzle. Before a buyer even glances at a spreadsheet, they're looking at the brand. And this specific establishment, it's being marketed as a premier turnkey opportunity. You're stepping into an established brand that already has a highly receptive audience. The listing really highlights an exceptional reputation, boasting a super strong 4.4-star rating backed by nearly 600 reviews. When customers are constantly praising a place for its top-tier service and relaxing environment, it tells an investor that the goodwill in this community is locked in. You aren't just buying pizza ovens here, you are buying customer loyalty. And while the name on the door obviously highlights pizza, their diverse menu is what actually builds that consistent community following. Their signature favorites range from specialty pizzas and calzones to these really delicious Philly-style cheesesteaks and massive fresh salads. And honestly, this is a brilliant operational strategy. The pizza draws them in, sure, but a wider variety of high-quality comfort food ensures that this spot becomes a regular dining choice for all sorts of different tastes and dietary preferences. It keeps that revenue stream wide open and very active. Which brings us to Section 2, inside the daily operations. A great menu is wonderful, right? But how does this $1 million machine actually run on a day-to-day basis? Well, this staffing breakdown is incredibly revealing. They manage this high volume with only 3 full-time employees, relying instead on a veritable army of 11 part-time workers. This structure is key. It gives the owner significant flexibility to scale labor costs up or down depending on the rush, say a crazy busy Friday night versus a really slow Tuesday afternoon. It keeps the overhead manageable while ensuring the efficiency you need to maintain those 4.4-star reviews. But hey, don't let that turnkey label fool you into thinking this is just passive income. Not at all. The current owner works 45 hours a week running this operation. It is a very hands-on commitment. It's also really worth noting the remarkable staying power here. This is a 17-year-old establishment, and the current owner has successfully managed it for the last 15 of those years. Let me tell you, that kind of longevity in the restaurant industry, that is a massive green flag for stability. And part of that stability definitely comes from their operational footprint. This isn't just a dining room. The facility is fully equipped to capture multiple revenue streams. They are optimized for high-volume takeout and delivery, which, as we know, is absolutely crucial in today's market, while still maintaining a comfortable dine-in experience and outdoor seating. So they're catching the quick-serve crowd on their lunch break and the sit-down families on a Friday night. They've got all the bases covered. Now, let's slow things down just a bit for Section 3, slicing the financial pie. We're going to take that huge initial revenue and slice it down piece by piece. We've seen the $1 million top line, but now we need to see what the business actually yields. Let's walk through this income statement step by step. We start at our peak, $995,000 in gross revenue. Right off the bat, the cost of goods, the ingredients, the pizza boxes, the immediate cost to make the food, that takes a massive $645,000 bite out of that top number. So that leaves a gross profit of $350,000. But wait. Then come the operating expenses, rent, utilities, labor, insurance, eating up another $321,000. Look at that final line. The stark reality is a net profit of just $29,000, from nearly $1 million down to $29,000.
If you stopped right here, you might think, wow, this is a terrible investment. But in small business accounting, net profit is rarely the whole story.
To find the true financial benefit of owning this shop, we have to calculate the discretionary earnings. Here's how that works. We start with that $29,000 net profit. Then we add back the owner's salary of $65,050 because as an owner-operator, you are paying yourself. Next, we add back $6,500 in depreciation, which is really just a paper loss for taxes, not actual cash out the door. Finally, there's another $17,000 in other expenses. These are often things like personal vehicles, cell phones, or one-time costs run through the business. Add all of that up, and the total discretionary earnings, the true owner benefit, is a much healthier $117,550. And this brilliantly illustrates why this specific business is attractive. Not only is the owner's take-home pay well over $100,000, but it is actually growing. Look at the comparison here. In 2024, the discretionary earnings were $107,408. The 2025 projection jumps up to $117,550. That shows upward stability, and it really proves the business is successfully navigating inflation and keeping those margins intact. Let's move right along to Section 4, Assets and Overhead Costs. So we know what the business earns, but what physical value is the buyer actually getting here? If we break down the tangible assets included in the sale, it totals $25,000. The largest chunk of that is $15,000 for furniture, fixtures, and equipment. We're talking the ovens, the tables, the point-of-sale systems, the whole shebang. You also get $5,000 worth of on-hand inventory and $5,000 in leasehold improvements. This is clearly not an asset-heavy play, right? You are primarily paying for the cash flow and the brand, not expensive real estate or million-dollar machinery. Speaking of real estate, this next number is absolutely crucial. $2,915. That is the highly favorable monthly lease rate for their 1,200 square foot space in a strip center building. Let me tell you, keeping overhead rent low is literally one of the biggest secrets to surviving in the restaurant industry. So, locking in this lease rate is a very strong competitive advantage for the incoming owner. And that rent is buying them a fantastic position. Situated right in a bustling retail corridor in Largo, Pinellas County, the business benefits from excellent visibility, a high density of households, and super consistent daily foot traffic. This specific location acts as a resilient, go-to hub for the community. The customers are quite literally built into the geography of the neighborhood.
We're entering the final stretch now. Section 5, Structuring the Final Deal.
So how does a buyer actually pay for this cash-flowing community staple? Well, the listing sets the total asking price at $230,000. But right below that, the required down payment is listed as $200,000. Now, any keen observer is going to immediately notice a gap there. If the asking price is $230,000, but the cash needed at the table is only $200,000, what exactly happens to the remaining $30,000? Now, what's really interesting about this slide is the fine print. To bridge that gap, the seller is actually offering to finance the missing $30,000 themselves. They are offering a 36-month seller loan at a very reasonable 6% interest rate, which comes out to a monthly payment of $912.66. Guys, this is a massive signal of confidence. When a seller is willing to hold a note and finance part of the deal themselves, it tells the buyer they believe this business will easily generate enough cash to make those monthly payments. So we've walked through the sizzling $1 million revenue, the reality of the $117,000 discretionary earnings, the 45-hour work weeks, and that incredibly favorable lease. With all the ingredients laid out on the table, is this 17-year-old profitable, turnkey operation worth bringing $200,000 cash to the closing table? It is a fascinating look at the grit and the reward of local business. I hope this explainer has given you a whole new perspective to chew on the next time you grab a slice from your local pizza shop.